Investors and traders, welcome to the channel. Today is 4th of August 2024, and I hope everyone is having a great weekend. This is going to be the market chart patterns weekend review. We'll be taking a look at the US markets as always. This video is for educational purposes only and it's not a financial advice. So we'll start by taking a look at the market commentary, so the price action and what kind of things happened last week, and we'll also take a look at some of the macro elements, and then we will actually dive into the market technical analysis, and we'll switch over to our trading view and we'll begin to analyze the chart patterns. So starting with the market commentary, we had stock market declines all across all the four major indices that we follow for the US markets. That's the S&P 500, the Nasdaq 100, Dow Jones Industrials, and the Russell 2000. And it felt like it was a liquidation event that some of the highly leveraged players in the market, perhaps they were having to liquidate their positions, square off their positions, because everything actually sold off. So we had a situation where the stocks began to decline as earnings were disappointing coming in from Amazon and later on Intel as well. The artificial intelligence, tech, and growth stocks, they suffered a lot. An interesting thing to watch was the small caps. Small caps in which we had seen a rotation, and they were beginning to actually outperform some of these major or the mega cap stocks. Actually, they sold off really bad last Friday in particular, and the Russell 2000 fell by minus 3 standard deviation, which is very rare, and this might actually be probably related to the unwind of the carry trade. More on that later on. And the gold sold off, the dollar sold off, the stock still sold off, the crude oil sold off. But what was actually performing much better was the treasuries. So the T-bills, T-notes, and the T-bonds, they actually rallied. So I think it was a flight to quality where players were getting out. The money was moving out of other assets and moving into the treasuries. And also a notable event is that the Bank of Japan actually raised their interest rates last week, which is ending their cycle of having really low interest rates and negative interest rates. So that paradigm is over, and there is a big shift which is away from the carry trade. Excuse me. And now if we just look at the stock market's declines, we can see that in percentage, the Russell 2000 small cap actually fell by minus 7%. Now that's pretty significant, all in 1 week. And the second worst performer was the Nasdaq 100, the tech stocks, high growth stocks, minus 3.45%, and both the Dow Jones Industrial and the S&P 500, they fell by over 2.5%. Now, last week, midweek, we also have the FOMC meeting. So the Federal Reserve, they came out and they actually held the interest rates, so the Fed fund rates, but they actually did sound neutral to dovish. And it looks like the September rate cut is actually being priced in by the market. So the expectations are being built into or being priced into the market are a rate cut as high as 50 basis points. But the chances are we might only get 25 basis points, and that's something which the market might not actually like. So if the market keeps on, declining, then the chances for a larger rate cut could in fact increase, and there is a chance that by the end of 2024 we might get 2 to 3 rate cuts. So what it actually means is that if the Federal Reserve starts a cycle of interest rate cuts, it's not that in the next meeting they'll go and raise the interest rates, because if central banks, they're very conservative. They actually like to build a cause, a momentum, and then the market participants aware of kind of what to be expected in a in a manner that perhaps the market is able to gauge some of that. So this is what might actually happen in terms of the rate cuts, and then the Intel stock, it actually plunged. Weaker earnings, and also the Intel is laying off about 15% of the workforce. So that's something worth noting. If you remember, a few months ago, back in March and April, we were talking about the IT industry is likely to actually start laying off more people, and this is some of the things that we are seeing in chips related stocks. Now, if you look at this chart, this is the weekly chart of Intel. Look at the price action. The market actually went below the 78.6% retracement, and this is the stock of Amazon, which actually also came out with weaker guidance from its retail operations. And from a technical perspective, we have this big ABCD actually completed. This is something which we have actually spoken about before, and it looks like, in my view, that Amazon may have put in a major top. So a major top might be in place for the Amazon stock, and also this is one of the stocks which likes to do a double top and a double bottom. So it did a double bottom around here, a double top around here, and a double bottom around here. So with this bigger ABCD completing around here, this could actually be kind of a double top formation in my view, because just went above by about 15-12 bucks, maybe close to 200 from these highs back in 2021. Moving on to the macro. So on the macro side of things, of course, we discussed the Fed fund rates. They were on hold, but the expectations are building for a September rate cut. Non-farm payrolls, they came out and they were much weaker than the expected. So 114,000 versus 176,000. So much weaker than what the market was expecting. But the real key thing was this unemployment rate. It came out at minus 4.3%, and it's on a rising trend, because on a previous reading we had also seen a rise in the unemployment rate, and this is something which the Federal Reserve is really watching really closely, because this is something which has actually helped them from cutting rates, because the unemployment rate has been very low from a historic basis, but now it seems to be creeping up. So it's going to give more cause for a rate cut, in my opinion. Now, with the unemployment rate rising, this is a consecutive reading in which it went up. This is actually raising a concern for a recession. In other words, a hard landing. More on that a little bit later on. So what is interesting to observe is that the bond market actually rallied, but stocks sold off. So this is a direct market feedback that bad news is bad news. What it means is that it was that even that we saw where the bond market began to rally and the stocks were actually selling off, was a move into the quality or into the safety of the treasuries. And also all of this could in fact be related to what we saw, big declines in the stock indices related to the unwind of the carry trade. So I've actually done a video about the carry trade, the unwind of the carry trade, and why what we are seeing, where we are seeing actually the tech stocks, the growth stocks actually being sold off, what could be behind it, and we talk about the carry trade, what it is, how it is being impacted by Bank of Japan, which actually raised the interest rates, and they ended their zero rate paradigm, and which is actually causing these funds which who might be fairly leveraged and borrowing in a lower yielding currency and investing in a higher yielding asset, might have to actually now deal with a really persistent central bank, the Bank of Japan, who is not just only intervening in the currency markets, but is also raising their interest rates. So this shows that how serious they are to actually raise the value of the Japanese yen, which actually went really low since 1986 or 85, and things were getting expensive in terms of import in Japan, and so they decided to intervene in the markets in a pretty big way, and that's of course is having its repercussions in the markets, in particular US markets. Also, it meant that the Japanese stock market actually plunged last Friday, and what we also saw was this currency pair, the USD dollar versus the Japanese yen, also plunged as yen became much stronger. Now, the currency markets, they are about the total volume roughly traded is about 7 trillion on a daily basis, and the largest currency pair is the Euro USD, and the second largest currency pair traded is the USD Japanese yen. So you can see that when we get to take a look at the dollar index, that when the dollar sold off, that might have something to do with the yen becoming very strong. So here's the chart of the Nikkei. This is the Japanese stock market, and here you can see this is on the weekly basis. Pretty bad week for this market, and of course with the interest rates going up, the cheap borrowing era is kind of over, which means that the Bank of Japan in the future might actually be able to raise slightly more rates. So that is also being reflected with the asset prices, which were really high, actually falling now. And this is what the USD Japanese yen chart looks like on the weekly basis. We can see a decline like this, pretty strong decline on the weekly chart. When we have a strong move like this move is likely to continue to the downside, which means that we could have further repercussions coming in, most likely in the stock market as well for the United States. Here is another really interesting one. This is the SAM rule indicator. And what this indicator signals is the start of a recession when the 3-month moving average of the U3 national unemployment rate rises by 0.5 percentage points or more above its 12-month low. So we'll take a look at that on a chart in the next slide. The rule has triggered approximately 1 to 3 months into last several recessions, and the beginning of each recession retroactively determined by the NBER, which is the National Bureau of Economic Research. So this is another reason to expect rate cuts by the Fed, because they do watch the unemployment data and this indicator perhaps, and they will be fairly concerned by the rise in unemployment, and that's going to give them some ammunition perhaps on the rate side to cut some rates, in my opinion. Now this is what the data looks like coming in from the Federal Reserve, and this indicator was actually introduced to us by Claudia Sam, who had actually worked I do apologize if I'm pronouncing the surname incorrectly. Do apologize sincerely. And I think she had also worked at one of the Federal Reserve, and that's how she worked on developing a really simple kind of an indicator, and which has been a pretty reliable one. So the rule indicator is at 0.53%, so a reading of a greater than 0.5% or greater signals a recession. So the recession risk is actually increasing. It's fairly high, and what we can see is on this chart, these gray zones, these are recessions. So a really short one in 2020, March of 2020. This is the great financial crisis. This is the 2000s crisis, and look at this black line, which is kind of really close to zero around here. And this is the chart coming in from Bank of America, and contributed also by Bloomberg. And here you can see how the U rate has been, and this is the SAM's percentage, and the recession starts 4 months prior. You can go and have a look at this one. Another really interesting chart come to us by Marcelo P. Lima. This is posted on for example X or Twitter formerly. This is the aggregate personal savings, and what we see is the savings had actually gone up a lot during the pandemic period. Of course, there was a lot of stimulus coming from the governments, and here now this is kind of being spent here, and this red area drawn excess savings. So a lot of consumers, a lot of people actually are using the excess built up of savings now, which will actually begin to cause constraints. And what we had actually seen is this chart also comes from Marcelo P. Lima, that the credit card usage had gone up. And what is this chart is indicating to us is a cumulative aggregate pandemic era excess savings, they have actually been in a decline, and they have declined by quite a lot. And this data comes, the source is Bureau of Economic Analysis, and then there's a further authors calculations part of it. So another one to keep an eye on. And then what it means is basically we are beginning to see more delinquencies coming out. This comes from New York Fed.org, and look at this one. This is the those borrowers who have actually maxed out, and they are now beginning to default, and we begin to see higher delinquencies coming up from that. And then we will now begin to get into the technicals of the market itself. So here we go. So what we are looking at is a daily chart of the Dow Jones Industrial Cash Index, and this is our model for timing that we have been using for quite some time. It has made some really fantastic call. More recently, the past week, we were getting a timing between last Friday, 26th of July, and 29th of July. With timing, we have to give it 1 to 2 trading days either side, and we were looking for at least a bounce, and this is what we got. In fact, we got a monster rally. Unfortunately, the rally fizzled out, and then we have seen further declines come in. Now the next key dates to watch are between 29th of August and 3rd of September. We'll have to give 2 to 3 trading days on either side with the timing, and we'll find out what this timing brings for us. Now if we move on to S&P 500, here we go, and I am going to move to the weekly chart first. Okay, here we go. So the first thing I would like to point out is look at this blue trend line. It's just a long-term trend support line, which is intact. Now on the weekly chart, what we have seen is a pullback coming in right from this 1.618 expansion of this bear market of 2022. We did have higher targets based on a 1-to-1 price projection EBCD. They may still get fulfilled later in the year. That remains a possibility. In Nasdaq 100 futures chart, we have already completed a big ABCD, slightly different pattern there, but it looks like if it doesn't come to fruition, then this 1.618 was the kind of the level that the market actually went to, rejected higher prices, and it's just been moving lower for 3 consecutive weeks. The last time we saw this sort of price action in the S&P 500 was in the month of April, and back then we got about minus 5.78% of the pullback. This pullback has actually slightly exceeded that, and this pullback has also exceeded my expectations, to be very honest, because I was thinking maybe we might get something like a 5 percentage point move, but we have exceeded that, so that is a little bit surprising. But I often get surprised but never in doubt, because we watch the technicals here. So what does it mean? Where we are, we'll just have a look at that on a daily chart, but it's completing we're very close to completing a 1-to-1 price projection ABCD pattern, and also these were the last correction in terms of the magnitude, that is exceeded slightly below that on intra-week basis, but closed pretty much at that level. It reached the 23.6% retracement of the lows of October 2023. So it does have some support around here, and it's possible that early next week we might see, which might at least be a bounce, or the market could rally into certain resistance points. So we'll just have a look at that on the daily chart. So this is the daily chart of S&P 500 cash index, and let me actually blow it up for you. There we go. So you see that here we had this brown ABCD that we see. This is what we were looking at last week by the end of the week, and this is what was because of this, it was also right at this 38.2% retracement of the lows of April 2024, and we had this nice ABCD completing, and we had the timing coming in. That actually gave us the confidence to say actually we are like to see at least a bounce, and we got a fairly large bounce going. It went right to the 61.8% retracement. It filled this gap around here. This is where the sellers were actually sitting. And we saw a pretty substantial decline on the 1st of August 2024, and the Friday actually continued with more economic data. I believe this is when the Bank of Japan also came out and raised their interest rates. So another reason the carry trade, for example, might have something to do with this. But now where we are in terms of the technical pattern, we have this red ABCD completing around 52.90 roughly, which is also the 50% of the April lows. And let me check if it's also close to any other. Yeah, it's also going to be very close to this structural support around here. So with this ABCD and 50% retracement around here, confluence of two things, there is a possibility for at least a bounce to take place. And now if there is going to be a bounce, then what are the areas it can bounce into? One of the things is that this trend line, this dotted purple line, it was broken, so that could actually in fact now act like a fulcrum where the price might get attracted to, but it might actually also turn into resistance level. So that is one possibility. If we just draw our retracements, and it's not sure that where the actual low is, but assuming this is the low, then let's see. I'm gonna draw 50% here. So we can in fact see a rally up to here. Let me actually try drawing it like this, roughly up till here. If the market actually rallies to 38.2% retracement and finds strong resistance here, that actually will indicate that a market could actually accelerate to the downside really quickly, because it's going to be a retracement from the 38.2% retracement, which is for the stronger trending markets. However, it's more likely to go to the 50% in my opinion, and around here we'll have to wait and see what the market is likely to do. Another possibility is that, which usually happens around the bear moves, and this is what we saw around here, the market would actually typically go and tackle one of these key swing points. Maybe it gets very close to it and tries to actually get slightly above that, maybe like a cent, and that's where it might actually trigger some stop losses. Maybe there might be some limit orders sitting there. So the bears who want to sell, they might have orders to sell there, and we could see a continuation of the bear move. So that possibility is there, and let's see, that might be the 61.8%. No, in fact, it's a little bit higher. So yeah, around 78.6% retracement. For now, I'm going to just limit to the 38.2%, 50% of this swing, and then let's see if we get a confluence level from this swing to here. Yep, so we do have some confluence coming in. Yep, so what I am getting is a confluence of two around 54.30 and anywhere between 54.79 and 54.60. So that's the kind of area we can have a look at where there could be potential strong resistance. Frankly, getting above that, I think the market will be getting stronger, and we might have seen a pretty we might have seen some sort of bottom come in. Now, if it begins to do that, begins to get above the 50% mark, in my opinion, then it will start a bottoming process. It might not be able to bottom straight away like a V bottom. It might actually come down, fill in these gaps, or even try to challenge these lows around here, but it's going to be a bottoming process, and then we could have actually a stronger move to the upside, which could actually challenge these highs one more time, maybe even try to take those out, and then we'll have to evaluate that if we get such a move. But this is what we are actually looking at. And now if I move to the ES SP500 futures, slightly different pattern here, but very similar to the cash. One of the things when we were expecting for a rally to come in, was we had identified these gaps, and this is what we're looking for, that the market is likely to move into these gaps, and this is exactly what we got. This is picture perfect. You know, we had the timing come in. We also have this ABCD blue pattern, which is giving us the confidence that we should at least be seeing a rally coming into the market, and then this support was being respected, and then we got a monster rally on Wednesday, which is the last day of the month actually, and the very next day after it filled the gap, boom, we saw the reversal of that, and just told us it was nothing more than actually a bounce. These were the standard deviation levels, and these are the deviation levels of last week, not for the week to come. And what we can see is that the market moved between -1 and -2 standard deviation levels. It did not break below the -2 standard deviation, which is actually kind of a good news. In terms of in futures, we have seen about -6.77 percentage point move, which is actually slightly lower than what we saw in April in the futures market. Now, look at this price projection ABCD in red. It's slightly below that. Below here, we also have some structural support, 50% retracement of the lows of April. So we have a number of things actually around here. So this is what we will be watching, how the market is actually going to trade if it gets there. Moving below this low, of course, for 5208, it's going to be pretty bearish. So for now, the market is completing some of these ABCD patterns, so we should expect early in the week at least a bounce to come in. And in terms of if the bounce does come in, really easy way to actually look at this is the market symmetry concept, and what it means is I don't know exactly where the low is going to be, but let's see if the low was here, assuming that, then 54.86, and then if we just run a retracement around here, yeah, that's going to be a pretty close to the 50%, which is kind of, you know, expected. Excuse me, it's going to be close to 38.2%, and it's going to be from this high to the assumed low. Here we go. I believe it's going to be more like a 50%. Yeah, so this is something which we could be taking a look at. Now, let's move to the Nasdaq 100. Before that, actually, let's take a look at the weekly chart of S&P 500 futures. This is the weekly chart. Again, just like the cash market, 1.618 of the entire 2022 bear market. Market not able to get above that. We see 3 consecutive negative weeks. This is something which we saw beginning of April, and then we have had this nice inside bar candle. So let's see what we get next week. But we do have some support levels which we saw on the daily chart nearby. This is the big ABCD which the Nasdaq has completed, Nasdaq 100, but the S&P 500 has not. So we were still thinking that maybe this market, which might be slightly out of phase, might actually go and complete this cycle. So that's why I still have it here. Too early for me to remove it. I personally believe we might actually see another higher high for the market. So waiting to see how the market will unfold. But these different lines that you see, these are the market symmetries. This is the decline that we had seen, last year, late July, sell-off right into October. So from an absolute points perspective, this is what we see, 5200 roughly. We are completing an ABCD nearby. This is the previous correction. This is something which we already taken a look at the daily chart. Now let's move on to the Nasdaq 100 futures. Oh, here we go. So you can see this big ABCD in green got completed. The market went right to our level, right to the level that we were watching, 20,750. Unable to close above that. Next day we got frankly a sell signal, and for the past 3 weeks the market has been moving lower. Now, one of the things is that on this futures chart, we have about 12% pullback, and that's very close to the pullback that we had in July, starting in July 2023 and ending in October 2023. Let's see what will come our way. So there's a good chance actually that where we are right now, in fact, that might be a strong support level. The possibility of this is because this is a 38.2% retracement level from the low of October 2023. So that is something very interesting to watch, because in stronger trending markets, 38.2% retracement is particularly coming from a major swing low or high tend to be pretty good support or resistance level. So at least we could expect some sort of a bounce to develop in this market early next week, perhaps, and then this region where our RET, that's a retracement, this is the region where it could find pretty strong resistance if we do see a rally coming. So that's what we are watching for the Nasdaq 100 futures on the weekly chart. And if you move to the daily chart, here we go. Now here's something which is our direct market feedback. So here on the 25th of July, we had an event where the market came very, very close to the minus 2 standard deviation levels based on the index Wixen, which is the VIX index for the Nasdaq, but actually went below if we just use the VIX. In the previous occasions, the market had in fact rallied when it sold off to minus 2 standard deviation or came very close to it. This time it did not. So this is direct market feedback that perhaps this market is operating in a different kind of phase now. So the market is moving into a phase where there is quite a lot of pressure to the downside. In fact, that possibility is still there. But where we are right now, you can see this. I've not labeled this ABCD, but using this swing, this one. We can see it's completing an ABCD pretty much where it closed, not closed, the lows that it had seen last Friday. So it's very, very close to that. And also it's a 38.2% retracement from the lows of October of 2023. So that 38.2% has significance. And of course, there is this low coming in from the 31st of May 2024. Let me actually try to highlight this using this. So it's going to be pretty interesting to watch and see what this market is actually likely to do. Another interesting part is that we can actually do this right now in terms of percentage. This is the entire decline of the 2023 correction that started in July, middle of July 2023, and finished in October of 2023. That was about 12%, and this is pretty much where we are now as well. So that's another interesting symmetry in the market from a percentage perspective, not necessarily the absolute. So there we go. So interesting to actually see that. Now if we move to the Dow Jones Industrial, this is the daily chart. You can see that the Dow Jones is actually stronger, at least from a pattern perspective also, than the Nasdaq 100, and also to some extent the SP500 in my opinion. But it's also forming this ABCD pattern around here. In fact, it went a little bit low, right to the 50%. So I've highlighted this using this shaded area. So that's pretty interesting to watch. So we could expect at least a rally or a bounce at least to come in. And if we were to draw some sort of a trend line for a support, we have that a little bit later on, lower as well. And moving to the Russell 2000. So this is daily chart. You can see the decline, really strong decline is coming right from the 1.618 expansion. It's more easily seen on the weekly chart. Here we go. There we go. So I was really thinking that we might actually be able to see this ABCD shown, so the market get to 2370 but we are drawn this box around here. We were looking for the market to get into this box, is what it did, right to the 1.618 expansion of this entire range to the point, and it had a really nasty close last Friday. Now, one of the things is that some of the funds, which leverage speculative funds, they have been actually running positions where leverage positions, shorting the small caps and going long the mega caps or growth stocks. So with the Bank of Japan's intervention in the currency markets and for them to raise the interest rates, there is a really clear message that how serious they are in terms of their intention to strengthen the yen. So which also means that speculative funds who have been involved in the carry trade, where they are borrowing in lower yielding currency and investing into higher yielding currencies, they might actually have had to cover a lot of their positions. And what we might have seen in last few weeks, strength coming into Russell 2000 might actually be related to squaring off some of those positions with some of the other mega cap stocks that some of these funds might have been involved in. So in the video done last week, I'd shown a chart of USD Japanese yen and how closely it is related to the price action that we see in the Nasdaq. So let me actually go here to Nasdaq, and let me actually do it in NDX actually. So this is the cash index, Nasdaq 100 cash index weekly chart, and I'm going to add USD JPY. Okay, let me do it in a new pane because it's gonna be slightly easy to see, in my opinion, that way. Okay, there we go. So you see the declines. We see the Japanese yen start to decline, and we begin to see the Nasdaq also begin to decline. Maybe a week later. And look at these bottoms. They are being really coinciding, these bottoms around here, slight divergence, but then as it starts its upward move again in the yen. But if you look at this, it's just been rising till it reaches a point where there is a lot of intervention happening by Bank of Japan, and then we begin to see a unraveling of the carry trade, the yen becoming really strong, and we begin to see the assets actually decline as well. So there we go. Apologies, a really long video, but we had to cover a lot. So thank you very much for watching the video. Good luck, good trading, and if you found this video of educational value, give it a thumbs up. And if you like our technical analysis using pattern recognition, Fibonacci ratios, retracements, projections, extensions and expansions, and also some of the macro elements for the weekend report, then please do subscribe to the channel. And if you do, then also hit that bell icon button. That way you will know when the new videos are posted and you will not miss on anything. So again, thank you very much for watching the video. Good luck, good trading, and I will be bringing in more videos intra-week as well. So stay tuned for that. Speak to you guys soon.